At some point in the last decade, someone offered this founder a number with 10 zeros at the end of it. He said no, not because the offer was too low, because he genuinely believed he was going to build something bigger. That decision became a case study, not the kind they celebrate at Stanford, the kind they use to teach behavioral economists about the psychological distance between confidence and delusion. Because here is what actually happened. The company reached a $10 billion valuation. It built an algorithm so good at reading human attention that even Jeff Bezos reportedly wanted a piece of it. The platform had millions of users, a recognizable brand, and a growth curve that looked, on paper, like the next chapter of e-commerce history. Then it collapsed. Not slowly, not quietly. The founder was pushed out. The company was sold for a fraction of what it once commanded, and the algorithm that was supposed to change everything became the mascot for a business school warning about overconfidence, unsustainable margins, and the particular kind of blindness that comes with being right too early. This is the story of how a $10 billion vision turned into a cautionary tale, and it starts with a line of code. It started with a problem that most people at Google considered already solved. How do you predict what a person wants before they know they want it themselves? Shulchevsky spent 6.5 years inside Google working on exactly this. Large-scale matching problems, feed algorithms, the invisible architecture that connects a human impulse to a result. He got very good at it. When he left in 2009, he did not leave to build a shopping app. He left to build something closer to a next-generation ad network, something that could outpredict Google's own AdSense system, which he believed had gone stale. He and co-founder Danny Zhang, both math graduates from the University of Waterloo, recruited their first 10 employees almost entirely from the university's mathematics department. This was not a design company or a branding exercise. It was a quantitative research lab that happened to sell things. The early version, called Wishwall, asked users to build wish lists of products they wanted but had not bought yet. What looked like a simple Pinterest clone was actually a data collection device. Every item saved, every category browsed, every hesitation before a click generated a signal. The platform was processing 30 million behavioral data points per day by 2014. That is 30 million individual moments of desire mapped, catalogued, and fed back into a model that kept getting sharper. Shulchevsky had not just built a store, he had built a machine that understood human wants at a level most retailers had never imagined. The pivot was quiet but decisive. Shulchevsky looked at the data his platform was generating and noticed something that changed everything. Most of the wish lists were full of items people had no intention of buying at full price. They were browsing, dreaming, running their eyes over things they could not quite justify. It was window shopping, and it was happening on an enormous scale. He realized that the business was not really about selling products. It was about sustaining the psychological state just before a purchase, that edge between wanting something and deciding whether to get it. If he could hold people inside that feeling long enough and present them with prices low enough to make the decision feel painless, the transactions would follow. The founders identified a gap in the market for budget-friendly goods, a segment often underserved by existing e-commerce platforms. Their target was not the Amazon customer who knew what they needed. It was the person scrolling at midnight with nothing specific in mind, susceptible to anything that looked like a deal. The platform began connecting buyers directly with Chinese manufacturers, cutting out distributors entirely. Delivery took 2 to 4 weeks. In exchange, the prices were almost absurdly low. A watch that retailed for $200 listed for $11. A drone that cost $400 elsewhere went for $32. The margins for the sellers were thin, but the volume was the point. Shulchevsky bet shoppers would be willing to accept weeks-long delivery times in exchange for bargain basement prices. By 2017, Wish was the most downloaded shopping app in the United States. By 2018, it was the most downloaded in the world with revenue of $1.9 billion. If you found this breakdown useful, subscribe. There are more stories like this one coming, and you will not want to miss them. At some point during Wish's rise, Jeff Bezos came calling. The exact details of the conversation have never been confirmed publicly, but the number has been widely reported across multiple industry sources. Wish turned down a $10 billion acquisition offer from Amazon, $10 billion in cash to walk away clean. Shulchevsky said no. His reasoning, at least as he expressed it publicly at the time, was not complicated. He had 90 million users. He had a revenue curve that looked like a vertical line. He had a machine learning system that Amazon, for all its resources, had not been able to replicate in the discount discovery segment. He believed the window shopping market, the invisible half of global retail that Walmart and Amazon had never properly served, was worth somewhere in the range of $100 billion. He had said as much in interviews. Why take 10 when you were building 100? This is a thought pattern that has a name in behavioral economics. It is called anchoring to an imagined future value. The founder is not comparing the offer to the current business. He is comparing it to the business he believes he's about to build. The gap between those two things feels like money left on the table. In reality, it is the moment where confidence stops being an asset and becomes a liability. At the time of the rejected offer, Wish had never turned a profit. Not once. He had 90 million users, $2 billion in revenue, and a $100 billion dream. The only problem was that the math had never actually worked. And no one at the top was looking at it clearly enough to say so out loud. To sustain that growth, Wish needed a constant supply of new users. The retention numbers were not good enough to rely on repeat purchases, so the company turned its advertising machinery into something that had never quite existed before in e-commerce. Wish was a crazy superpower in digital ads, using algorithms to serve ads to shoppers through Facebook and Google. But the creative strategy was where things got genuinely strange. The ads that flooded social media feeds in the late 2000s looked almost deliberately absurd. Oversized cat face masks, miniature chainsaws, compression leggings advertised on the most unlikely body types. The products seemed almost designed to provoke a response, any response, because a response was the point. This was not an accident. It was applied behavioral psychology. The bizarre images triggered curiosity, which triggered clicks, which trained the algorithm to find more people likely to click on bizarre images. Loss aversion was baked into every product page, with countdown timers and limited quantity warnings creating artificial urgency. The price gaps between a product's original listed retail value and the Wish price were frequently exaggerated or invented, but the psychological effect was real. Wish became the top advertiser on Facebook and Instagram, and among the biggest on Google, spending more than $1 billion on sales and marketing in a single year. That $1 billion brought an enormous reach. It filled the top of the funnel relentlessly, and for a period, it worked well enough that no one at the executive level asked the obvious follow-up question: what happens if we have to spend this much every single year just to stay still? Here is the number that should have ended the conversation in every board meeting from 2018 onward. In 2020, Wish lost $745 million on $2.5 billion in revenue. For every dollar the company earned, it spent $2, and nearly all of that spend, $1.7 billion, went to user acquisition. This is not a growth stage problem that gets resolved at scale. This is a structural contradiction. The business model required cheap digital advertising to deliver cheap products to price-sensitive customers who had almost no loyalty to the platform itself. The moment the ad costs went up, or the moment those customers found a better deal somewhere else, the entire construction collapsed. There was no retention layer, no brand equity, no logistics advantage that kept people coming back. The internal logic was that the algorithm would eventually become so good at predicting purchases that the cost per acquired user would fall and the margins would follow. It was a reasonable theory in 2015. By 2020, with a $17 billion IPO valuation and still no path to profitability, it had become a rationalization. When you burn $2 for every $1 earned, you are not scaling a business, you are scaling a bonfire. The IPO in December 2020 raised $1.1 billion. The market gave Wish a valuation of $17 billion on the opening day. None of the filings hid the loss figures. The investors read them and bought in anyway. Everyone assumed the losses would eventually stop. No one had a plan for making that happen. $17 billion on paper, $745 million in losses in a single year, and a business model with only one working engine. Then, that engine blew. The thing about building your entire company on paid advertising is that you do not own it. You're renting attention from platforms that can change their prices whenever they want, for any reason, and there is nothing you can do about it. When the pandemic hit in 2020, global demand for digital advertising collapsed briefly, then exploded. Every business that had been running on physical retail shifted its marketing budget online almost overnight. The cost of buying attention on Facebook and Google spiked sharply. For most companies, this was a manageable pressure. For Wish, it was catastrophic. Wish's user acquisition engine, its only real engine, imploded. The numbers tell the story cleanly. Revenue fell from $2.5 billion in 2020 to $1.7 billion in 2021, then to $579 million in 2022. By 2023, revenue had dropped to $278 million, a further decline of more than 50% year-over-year, and the net loss reached $317 million. The company had gone from the most downloaded shopping app in the world to a fraction of its former size in less than 3 years. There was a brief attempt to fix the advertising problem by diversifying to new channels, rebuilding the product quality standards, and rebranding. None of it addressed the core issue. The core issue was that Wish had spent a decade acquiring users it could not retain, using money it could not afford through a channel it did not control. Once that channel became expensive, there was no fallback. While the financial story was collapsing from the outside, something worse was happening from the inside. Wish had never invested meaningfully in the user experience. Refunds took weeks, sometimes months. Counterfeit products were everywhere on the platform. One internal experiment reportedly involved setting up fake storefronts just to see how many people would buy from vendors that did not exist. They did, in the thousands. The product that arrived rarely matched what was shown in the listing. Sizing was unreliable. Quality was inconsistent. For a while, the prices were low enough that customers tolerated it. A $5 purchase that disappoints is different from a $500 purchase that disappoints. The low price point was functioning as a psychological buffer against the inevitable frustration. But frustration compounds. By 2021 and 2022, the reputation damage had become measurable. App Store ratings were declining. Media coverage had shifted from curiosity to criticism. Regulatory pressure was growing in Europe, where French authorities pulled Wish from major app stores in late 2021 over product safety concerns. The customers who had tried the platform once, been burned, and never returned were not being replaced fast enough because the cost of finding new customers had tripled. Zulchevsky had built a machine that was brilliant at finding people who might buy something. He had built almost nothing to make them glad they did. In February 2024, on the same Sunday that Temu spent millions on Super Bowl advertising running the slogan "Shop like a billionaire," Wish announced it was being acquired by Singapore-based Q10 for $173 million in cash, 99% below its peak valuation. The timing was not a coincidence, it was a summary. Temu had arrived in the United States in September 2022 and done in 2 years what Wish had spent a decade attempting. It offered ultra-low prices, primarily sourced from Chinese manufacturers, the same core proposition as Wish, but with faster shipping, a cleaner platform experience, and real logistics infrastructure behind it. Where Wish had treated fulfillment as an afterthought, Temu treated it as a competitive weapon. Where Wish had ignored product quality complaints, Temu built return processes that actually worked. Temu then began outspending everyone on Meta and Google simultaneously, with agencies reporting that the influx of Temu ad spend was directly pushing up CPMs across the platform for competing advertisers. For Wish, which was already struggling to afford its ad budget, this was the final compression. The rival had taken the original playbook, removed every weakness in it, and scaled it with resources Wish could no longer match. Wish had taught the market how the model worked. Temu had taken notes and built a better version. Peter Zulchevsky stepped down in early 2022. His replacement lasted 7 months. 3 CEOs cycled through the company in a single year. Each one inherited a smaller revenue base, a weaker brand, and a cost structure that no longer made sense at the volumes the company was actually doing. In April 2024, ContextLogic sold all of its operating assets, including the Wish brand and its entire e-commerce platform, substantially to Q10 for approximately $173 million. The company that had been valued at $17 billion at its IPO less than 4 years earlier was gone for roughly 1 cent on the dollar. What remained of ContextLogic was a shell-holding company, retaining its NASDAQ listing and approximately $2.7 billion in accumulated net operating losses, but no longer operating any actual business. The algorithmic engine that had once been the most powerful behavioral prediction tool in consumer retail was folded into a pan-Asian e-commerce group that most Americans had never heard of. The $10 billion offer from Amazon, the $17 billion IPO, the rejected exits, and the $100 billion vision. None of it mattered in the end because the business had been built on a foundation that required everything to go right simultaneously forever. Ad costs had to stay cheap. User behavior had to stay predictable. The competition had to stay absent. None of those conditions held. What Sulchevsky built was genuinely impressive. What he failed to build was a reason for anyone to stay. If this story taught you something, subscribe and share it. The next one is already in production, and it goes somewhere you will not expect.